3 stocks under $5 quietly positioning for 2026 growth. You know what's fascinating about the stock market heading into 2026? While most investors are still chasing the same megacap tech names, there's a quieter shift happening beneath the surface in the under $5 space. I'm not talking about hype-driven penny stocks or social media lottery tickets. I'm talking about real companies with actual revenue, real products, and early signs of institutional accumulation. Today, we're breaking down 3 stocks trading under $5 that have the fundamentals, sector positioning, and potential catalysts to support meaningful growth over the next 12 to 24 months. And make sure you stay until the end, because the third company operates deep inside the semiconductor supply chain, a part of the AI and automotive ecosystem most retail investors are completely overlooking. At this price level, before we dive in, let's set expectations clearly. A 5 times move means a stock going from $4 to $20. That's rare. It's not guaranteed. But historically, when it does happen, it's because several conditions align at the same time: undervaluation relative to peers, improving fundamentals, a credible growth narrative, and changing market perception. We're entering 2026 in a mixed macro environment. Inflation pressures haven't fully disappeared, interest rates remain a key variable, and volatility continues to rotate between sectors. That environment tends to hurt small-cap stocks in the short term, but it also creates mispricing. Many sub-$5 companies are ignored simply because they fall outside institutional mandates, not because their businesses are broken. That said, these are higher-risk investments. Stocks under $5 can move 20% in either direction quickly. This is not financial advice. You need to do your own due diligence and understand that these positions should only represent a small, speculative portion of a diversified portfolio. With that foundation set, let's get into the first stock. Stock number 1, Ginkgo Bioworks, ticker DNA. The first company is Ginkgo Bioworks, a synthetic biology platform company trading well under $5 heading into 2026. Ginkgo's core business is engineering custom microbes for clients across pharmaceuticals, agriculture, food ingredients, industrial chemicals, and specialty materials. Think of Ginkgo as infrastructure rather than a single product company. Their platform allows partners to design biological solutions without building their own labs, automation systems, or data pipelines. Financially, Ginkgo is still in growth mode. Revenue has been inconsistent quarter to quarter, but the company continues to generate meaningful top-line numbers for a platform business at this stage. More importantly, Ginkgo entered 2026 with a substantial cash position relative to its market capitalization, giving it runway to execute without immediate dilution. What the market has punished is cash burn and delayed profitability. The stock trades far below its earlier valuations, and sentiment around synthetic biology cooled after the post-SPAC boom collapsed. But underneath that sentiment shift, the business continues to sign partnerships with major pharmaceutical and industrial players. The long-term thesis is simple, but demanding. If Ginkgo can demonstrate that its platform model scales, improves margins, and converts partnerships into repeatable revenue streams, the market could revalue the company significantly. Synthetic biology is projected to become a multi-billion-dollar industry by the early 2030s, and infrastructure providers tend to benefit disproportionately if they become embedded. Risks are substantial. Cash burn must decline. Execution matters. Platform economics must improve. This is not a near-term profitability story, but at current valuations, even modest progress towards sustainable margins could change investor perception heading into 2026 and beyond. Stock number 2, Sonova Energy International, ticker NOVA. The second stock sits in the residential energy transition space. Sonova Energy. Sonova provides solar and energy storage solutions to homeowners through a service and financing model. They don't manufacture panels, they manage long-term customer contracts, installation partnerships, and financing structures. The company has hundreds of thousands of customers across the United States and a large dealer network. The residential solar sector was crushed when interest rates rose sharply. Financing costs went up, demand slowed, and stocks across the space collapsed. Sonova's share price fell from previous highs into the under $5 range, despite continued customer growth. What changes the picture heading into 2026 is policy and structure. The Inflation Reduction Act extended residential solar tax credits through the next decade, providing a 30% investment credit that materially improves homeowner economics. At the same time, battery adoption is accelerating as grid reliability becomes a concern. Sonova has reported that a growing percentage of new installations include energy storage. The business model is capital-intensive, and debt levels are high, but much of that debt is asset-backed, and tied to long-duration customer contracts. That's a key distinction many investors miss. The question isn't whether Sunnova carries debt, it asks whether the cash flows attached to that debt remain stable. The upside scenario depends on financing conditions stabilizing or improving, installation volumes recovering, and Sunnova demonstrating it can manage cost while growing its installed base. If sentiment shifts back toward residential energy as rates ease or energy prices rise, the market could reprice the entire sector. The risks are obvious. Interest rates matter. Competition is intense. Cash flow timing is complex. This is not a defensive investment, but for investors looking at 2026 and beyond. Sunnova represents a leveraged bet on residential energy adoption, recovering from a deeply depressed valuation. Stock number 3, Indie Semiconductor ticker, Indie now for the third stock, and the one most people aren't paying attention to. Indie Semiconductor operates inside the automotive semiconductor supply chain, focusing on advanced driver assistance systems, sensor processing, connectivity, and vehicle intelligence. This is not a commodity chip business. Indie designs application-specific solutions for cameras, radar, LiDAR integration, and in-vehicle data processing. What makes Indie interesting heading into 2026 is scale. Revenue has grown meaningfully year over year, and management has guided toward profitability as operating leverage improves. Adjusted EBITDA has already turned positive, which places Indie ahead of many small semiconductor peers. At current prices, the company trades at a fraction of the valuation multiples assigned to larger automotive semiconductor companies despite serving similar end markets. That disconnect exists because Indie is still small, less well-known, and less widely covered by analysts. The real catalyst is regulation and adoption. Governments around the world are mandating additional safety features in vehicles. ADAS is no longer optional, it's becoming standard. Automakers need reliable, specialized semiconductor partners who can design and support these systems across multiple vehicle platforms. Indie has disclosed design wins with major automakers and Tier 1 suppliers. Those design wins often translate into multi-year revenue streams once production ramps up. If Indie continues executing and hits its revenue and margin targets through 2026, the market may be forced to reprice the stock closer to peer valuations. The risks are real. Automotive demand is cyclical. Larger semiconductor companies have deeper resources. Supply chain disruptions can still happen. Execution must remain tight. But among under $5 stocks, Indie stands out as a company already demonstrating operational momentum rather than just potential. Key risks you must understand before wrapping up. It's critical to be honest about the risks. First, volatility. Stocks under $5 can move sharply on earnings, guidance changes, or even sentiment alone. Second, dilution. Smaller companies often raise capital through share issuance. Always monitor cash balances and burn rates. Third, liquidity. Lower trading volumes can make entries and exits more difficult during market stress. And finally, time. These are not short-term trades. The scenarios discussed here could take 12 to 24 months or longer to develop. Some may never materialize. Ginkgo Bioworks, Sunnova Energy, and Indie Semiconductor represent 3 very different paths inside the under $5 universe. Heading into 2026, one is a synthetic biology platform, one is a residential energy service provider, and one sits inside the automotive semiconductor ecosystem. None of these is our safe bet, but each offers asymmetric risk-reward if execution improves and market perception shifts. The key is discipline, small position sizes, ongoing monitoring, and realistic expectations. Not every overlooked stock becomes a success story, but every success story starts with being overlooked. If you found this breakdown useful and want more research-driven analysis on overlooked stocks heading into 2026, subscribe to the channel. Drop a comment letting me know which of these 3 you want a deeper follow-up on, or what other sectors you'd like covered next. Thanks for watching, and I'll see you in the next video.